Elon Musk is about to shake things up in the insurance industry, and Warren Buffett's Berkshire Hathaway may be one of the first unsuspecting targets. With subsidiaries like Geico and Berkshire Hathaway Reinsurance Group, Berkshire boasts a formidable empire built on underwriting profits, cementing its position as a dominant force in the market. But lurking beneath this moat of success lies a potential threat that could disturb the very foundations of Berkshire's insurance business. Under Elon Musk's leadership, Tesla is advancing rapidly to unveil full self-driving software that will increase vehicle safety beyond what the industry has ever experienced. Car insurance companies may struggle to adapt their underwriting models as they're forced to recalibrate their risk assessments to keep pace with the evolving automotive industry, armed with limited data compared to Tesla's wealth of real-world driving information. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and quarterly financial data going back up to 15 years, and it's all freely available. The global vehicle insurance industry is absolutely massive, approaching $2 trillion in total premiums expected to be written this year in 2024. Elon Musk aims to disrupt and capitalize on this entrenched industry. However, Tesla originally entered the insurance business not because they wanted to, but because their customers demanded reduced premiums as a result of obscenely high prices charged by traditional insurers. Tesla vehicles have fewer moving parts that break, cameras surrounding the car watching 24/7, and built-in driver assistance features that prevent accidents, making Teslas the safest cars in the world, which is the basis for owners demanding reasonable insurance premiums for similarly priced cars. And so this industry practice of excessive pricing on Tesla owners has turned into a big long-term mistake, as Elon Musk has led the company in creating a new type of disruptive insurance product which has so far been making inroads starting with 12 US states. With the exception of California, Tesla has deployed its real-time insurance product, which gives drivers a personalized safety score, allowing them to save money for safer driving, the way insurance should be. This is interesting because it attracts safe drivers to join up with Tesla insurance, and these types of drivers are typically gold mines for any insurance company, as they still pay premiums but make fewer claims. Whereas reckless drivers may pay higher premiums, but typically claims that they make would be higher than any individual policy. And so this real-time aspect quickly rewards or penalizes drivers, making good drivers want to stay and bad drivers want to leave. In contrast, the cycle time at most other insurance companies is a full year before they figure out what's going on, which means good drivers may be upset that they're paying more for no reason, and bad drivers can get away with lower annual premiums relative to their intrinsic risk profile. And so Tesla inherently incentivizes the good drivers to be drawn into their insurance product, pushing the reckless drivers back to their competitors. As of last year, 17% of eligible Tesla drivers were using Tesla insurance, and this business continues to grow at 20% in the markets that Tesla resides in today. Not to mention that these are vehicles that otherwise would be signed up with competing insurance firms, and so Tesla is taking business from these other players even if their own insurance operations are still small for now. Ultimately, Elon Musk expects this business to be a meaningful part of Tesla. Note, however, that you don't ever want 100% market share in the insurance business, because there are a subset of customers that actually cost more money than they bring in. Insurance models are all about predicting who these people are and weeding them out, or perhaps making the premiums so high that they don't want to be customers. Strangely, we'll soon see that Tesla's FSD may flip this practice on its head. Now, the insurance companies seem to be starting to get worried, especially since this is just the beginning and they may already be feeling the impact. During Berkshire Hathaway's recent annual meeting, Warren Buffett was asked a question on how Tesla's full self-driving software could impact Geico, which is one of the largest car insurance companies in the United States. The question was that if Tesla's FSD software can indeed lower the number of accidents by say 50%, wouldn't insurance premiums fall to reflect this reduced underwriting risk, and hence adversely impact Geico's revenues and margins? Warren Buffett responds by saying that essentially yes, that would indeed be the case. They would see in their data that costs declined due to fewer accidents, and therefore the premiums would decline as well. However, Buffett cautioned that other companies have tried similar things in the past. He says, insurance always looks easier than it is, and it's so much fun because you get the money at the start and then you find out if you've done something stupid later on. This is how the insurance business works. The company pools together all of the premiums and subtracts all of the claims, with the remainder being their gross profit. The insurance companies also have the benefit of the premiums coming in up front, while the claims come later. So essentially they have all of this money before they need to spend it, which is called the float. And they can invest that money that really isn't theirs yet, and make additional interest off of it, for instance, which goes straight to the bottom line. But Warren Buffett didn't really answer this question completely, and the way the question was phrased may also be incorrect. Tesla's foray into autonomous driving technology with its full self-driving software is something that has never been done before, meaning that insurance companies are walking into uncharted territory. With each passing day, Tesla gathers an immense amount of data from its fleet of vehicles equipped with FSD capabilities. This data trove offers unprecedented insights into driving behavior and risk assessment. Insurance companies thrive on data, using it to calculate premiums and assess risk profiles. And so Tesla's vast and detailed data set, encompassing billions of miles driven under various conditions, promises to provide unparalleled accuracy in assessing driver behavior and predicting accident probabilities. If Tesla's FSD software proves to be safer and more reliable than human drivers, Warren Buffett appears to suggest that insurance companies may flock to leverage this wealth of data to refine their underwriting processes and reduce claim payouts. There's only one problem. No one else has this data except for Tesla, and the vehicles need to be equipped with full self-driving, which today only Teslas are. And so for starters, if Tesla succeeds in developing FSD technology that significantly reduces accident rates, traditional insurers like Geico could see their market share eroded as consumers gravitate towards Tesla's integrated insurance offerings. Especially if the premium is calculated in real time, consumers will see instant savings with Tesla, whereas other insurance companies won't find out if their claims were lower to be able to relay the benefit to consumers until the following year. They also have no idea what the driver's behavior actually is. While for instance Tesla will still allow the humans to drive the car, pricing them based on their safe actions. But when FSD is activated, insurance premiums will be programmed to drop immediately, encouraging people to adopt FSD. This allows Tesla to guarantee an enhanced level of safety when FSD is better than a human, therefore further undercutting Berkshire's competitive edge, leaving Buffett's insurance empire vulnerable to disruption. The insurance industry relies on precise calculations to determine premiums, maintaining a delicate balance of accuracy. If the premium is too high, customers will sign up elsewhere, and if it's too low, the company risks decimating their own profits. And so Warren Buffett says that reducing accidents by 50% will be good for society but bad for insurance companies' volume. It will certainly be good for society, but it actually seems like insurance companies would be poised to do even better and achieve record profits, at least temporarily, if this were the case. This is because their premiums wouldn't drop instantaneously. They could lower them slowly, and consumers would be happy with new discounts, while the claims, which is their costs, would fall, assuming a subset of their customers are Teslas with FSD. And so this would be very good for society, insurance companies, and consumers, besides the part that Berkshire Hathaway doesn't have Tesla's real-time data as to how people are actually driving. Again, this is dangerous for Berkshire because the driver has a choice to use full self-driving or not. Tesla sees that choice in their system the second it happens, such as when the driver enables or disables FSD, or perhaps even Sentry mode. Berkshire just sees the yearly or monthly claims, so they have no real idea what's going on under the hood, making it very difficult for them to actually lower the premiums for fear of making a mistake. Just like how Buffett recounts that during COVID, people drove less, but they drove more recklessly according to the data. And so the insurance industry has been burned in the past, which will now cause their premiums to remain high while customers call up Tesla Insurance to save 15% or more. Now, Berkshire's vice chairman of insurance, Ajit Jain, comments on this potential 50% drop in accidents and says that what people are forgetting to factor in is that these repairs cost more money specifically for Tesla. This is a strange thing to say for a number of reasons. It seems like he may be trying to play this off as not a big deal for Berkshire. There are roughly 2 billion combustion engine vehicles on the road today, with repair shops everywhere, lots of suppliers and manufacturers of parts, whereas there are only tens of millions of electric vehicles on the road. Over time, as electric cars gain market share, the cost to repair will likely come down. But this is still besides the point. He's really not factoring in what a 50% drop in accidents means. The Teslas that are being insured today versus the Teslas that are being insured in a future scenario with a 50% less chance of getting into an accident have the exact same repair cost, as we're still talking about the same car. And so the only variable that changed was the number of accidents. Repair cost has nothing to do with it. Furthermore, the original question itself implied a 50% reduction in the accident rate. But today, simply driving a Tesla versus any other car already statistically achieves this. Manually driven Teslas crash less than the average vehicle. Full self-driving aims to get multiple times better than this, amplifying the impact on the industry. If the vehicle crashes half as many times, that's one thing. But what if it truly becomes 10 times better than a human, as Elon Musk predicts, or even better than that? Crazily enough, even a reckless driver who's paying a very high premium at, say, Geico, becomes a safe driver by using FSD all the time in a Tesla. Imagine what that would do to the premium. It may not be the only thing coming crashing down, as Tesla siphons safe and risky drivers away from other insurance companies as a result of their full self-driving software. And so it seems that Berkshire management may not be looking deep enough into the future. However, what they're saying and what they're doing may be two different things. In a bid to diversify their portfolio, about a year and a half ago, Berkshire Hathaway acquired Allegheny Corporation, a move aimed at bolstering its insurance and reinsurance capabilities. Allegheny's core business is property and casualty insurance, essentially shifting Berkshire further away from vehicle insurance. But Elon Musk has a different suggestion for Berkshire in order to hedge their bets against the oncoming onslaught of full self-driving: to buy shares of Tesla as the obvious move. It's unlikely that Warren Buffett will do this, however, as he only purchases companies that he says he understands, and Tesla is a technology company that's typically out of Buffett's realm. However, perhaps Warren Buffett is learning a lot now that Tesla threatens the insurance industry, that he may understand Tesla a lot better now. Warren Buffett was late to the game in purchasing Apple, a technology firm that's also a retailer and a phone maker, actually not that difficult to understand, and his gains in Apple stock, even coming in late, have been tremendous. Buffett's late partner, Charlie Munger, passed on the opportunity to invest in Tesla years ago, although he did change his mind in recent years, calling Tesla a minor miracle. Furthermore, it's interesting that Warren Buffett is typically a huge proponent of American businesses and American ingenuity, and yet he's invested in Chinese car company BYD instead of Tesla, even though he has had an excellent return on BYD. Tesla hasn't done half bad either. So perhaps it's time for Buffett to make the switch into Tesla, not only as a hedge on the potential disruption of one of his major lucrative insurance businesses, but also as a bet on the type of human ingenuity he frequently admires, which Buffett believes is uniquely found in America. So do you think that Tesla's full self-driving software will be the invention that triggers the disruption of the car insurance industry? And how quickly do you think it's going to happen? Don't forget to watch my last video on Biden bringing bad news for China's EV market. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that helped to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.